Hello, everyone. Today on the final bar, we'll be talking to Jonathan Krinsky from Baycrest Partners. We'll talk about the overall market environment. It's a challenging environment for sure. You had distribution going into the close yesterday, further distribution today, but the damage was really done out of the open with stocks largely selling off. The S&P finishing down about 0.75%. Only one of the S&P sector's financials finishing in the green. The rest really flat to quite negative. You look at some growthy stuff, particularly technology at the bottom of the list. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of stock charts, using our data visualization techniques, the technical analysis toolkit to better understand investor behavior, focus on the messages of price, trend, momentum, breadth, sentiment, all those indications that can help us get inside the head of the investors out there, try to make sense of these markets in uncertain times. I was doing an interview earlier today and was asked about the market environment, particularly going into year end and just the volatility that we've seen. And what I tried to explain to them was the markets, I would argue, they like certainty. They don't like uncertainty, or certainty is probably always impossible. They like stability. Uncertainty, the unknown is not something that kind of calms investors down and lets them settle into a long-term uptrend. That's when people get panicky and emotional. And I think we're seeing a lot of that manifest today and really this week. We have the Fed meeting coming up tomorrow. It's obviously fairly significant. This is where we could get a lot more clarity in terms of a timeline for rolling out changes in Fed policy, what next year might look like in terms of potential interest rate hikes. So a lot to digest tomorrow for sure. What we'll do today is look at the message that the markets are providing us today. What can that tell us about the overall environment? I'm excited to talk to Jonathan Krinsky here from Baycrest Partners in a little while. We have great guests on the show all during the week. Tomorrow, by the way, we have Ms. Schneider from Market Gauge. On Thursday the 16th, Sam Stovall from CFR Research in New York. Sam literally wrote the book on sector rotation, so it'll be a lot of fun now that we're seeing some defensive sectors starting to improve a bit. A couple other things to let you know about. The Pitch is our monthly stock picking showdown with 3 guest experts, each providing 5 tickers each and justifying them with the technical toolkit. You can go to stockcharts.com/thepitch for information on our next event that's coming up this Thursday. I'll be moderating a discussion with Aaron Swenlin from Decision Point, T.G. Watkins from Simpler Trading, Larry Tentarelli from Blue Chip Daily. You can also see on that website all of our previous episodes. We will be taking the last 2 weeks of the year off in terms of live programming. We will be bringing a ton of great content for you. And next week, we'll be doing some top charts of 2021. The week after, we'll do a special series on reviewing and recapping your performance for the year and how to set yourself up for success next year. Also, all of the next 10 days, starting next Monday, that week of the 20th and the week of 27th, every day, one of our guest experts will be providing an influential market event through the lens of technical analysis. It's going to be an incredible 2 weeks of market wrapping, year-ending sort of content. So check that out here coming up on Stock Charts TV. Let's continue on with our market recap. I mentioned in a little preview we sent out on social media a poll question. I did a webinar earlier today for market misbehavior, and I asked all the attendees, a couple hundred attendees, and I asked, where do you see the S&P closing 2021, above or below 4,700? I almost said 2,700, which wouldn't be much of a poll. So we're at 4,700 here. That's the brown shaded area on the daily S&P chart. And I asked the attendees, do you think 2021 is going to end above this brown shaded area, above 47 or below? It was literally almost 50-50, the results of the poll. 54% said above 4,700, 46% said below 47. So talk about a completely almost dead even reaction. And when I think about uncertainty, I think about indecision. The results of that poll were just a perfect way of wrapping up the way that I think this market sort of looks right now. Let's look at what happened today overall. As I mentioned, the S&P recovering a bit in the afternoon, pulling back into the close, but really the damage was done right out of the open. The first couple hours were fairly weak. The S&P finished the day around 4635, just below there. That's 7.8%. Below yesterday's close. The NASDAQ 100 down just over 1%. Mid caps and small caps down as well, not as much as the S&P, so down about 0.5% or so. The VIX is back above 20, continuing to climb. It's just below 22 here at the end of the day. Interest rates pretty volatile, and I think that's to be expected given the Fed meeting today and tomorrow. Powell's press conference, the Fed minutes always potential for lots of movement there, particularly in the press conference. Afterwards is when we've seen a lot of fluctuations in interest rates in the S&P potentially as well. But 10-year yields going back to the upside. It got up to around 147 on the 10-year, but settled in around 144, just below that. The dollar index continues to push higher and higher. And when you look at the relative strength of the U.S. versus non-U.S. or SPY versus ACWI, which is a global index, the ratio has been favoring the U.S. for quite some time, continues to appear that way here, given the strength, I think, in no small part, the strength of the dollar. Commodities as a whole down in a fairly decent way. Gold and silver both down about 1 to 1.5%. The commodities complex using the DBC was down about 0.9%. Energy prices lower as well. The XLE was about mid-range relative to the other 11 S&P sectors, the other 10 S&P sectors. But overall, commodity prices a little weaker here. Cryptocurrencies bouncing up. Now, all these cryptos are up right now. All these coins are up from where they were yesterday. Worth noting, though, this is still very far below the levels we were at not too long ago. So Bitcoin, pushing up towards 48,000. It was at 50,000 yesterday, about 2 days ago, really. And not too long before that, up in the 60s, the upper 60s. So a lot of coins have come down fairly significantly. Bitcoin getting below 50,000, important. Ether getting below 4,000, certainly important as well. Remaining both of those were below levels of resistance. So there's been a distribution phase we're seeing across the board in crypto land. With some random exceptions in the altcoin space, the smaller, less liquid ones, but with the major ones all bouncing today off of fairly beaten down levels. Let's look at a chart of the S&P 500, just make sense of today's trading and how it fits into the big picture. When I look at the chart of the S&P, and every day, the first two charts I look at are this weekly chart of the S&P going back 5 years. That includes the market trend model we review usually on the show on Friday, and then also the daily chart of the S&P. We've looked at these every day that I think we've done the show for the most part, or I've looked at them every day. We talk about at least the daily chart of the S&P every afternoon. And what strikes me when I'm looking at this chart recently is just the lack of momentum, the lack of support for the S&P, right? A bullish phase should see the market making higher highs and higher lows, with the momentum remaining fairly elevated, right? And you could have some random divergences, but they resolve to the upside. You then see the market making higher highs, you see the momentum improve, and you continue to see this uptrend with the momentum overall remaining in a fairly constructive range. Look at how that has changed here in the last 6 to 7 weeks, where you've seen the new all-time high in November with the RSI around 76, 77. The subsequent attempt to eclipse 4,700 in late November saw the RSI just below 70. And now this week, we once again approach on Friday, get above 4,700, and the RSI is actually below 60. So we have the market unable to break out above 4,700 now for the last 6 weeks. We have the momentum consistently negative. So overall, that is not an encouraging sign overall. What you would need to see, I think, to clear that out and indicate a resumption of the uptrend, number one, getting above 4,700 and staying there, right? Breaking through resistance and holding that level would be important. The RSI getting back higher and showing improving momentum as the S&P is trying to get higher. Those are the conditions you'd want to see if you're bullish and looking for that push higher into year end. We're not seeing it today. You're seeing more defensive leadership. You're seeing momentum dry up a little bit. We're also seeing it in the breadth readings as well. I'm going to go over to the Mindful Investor Live chart list. We're going to go to this chart, which we look at usually on Fridays. We'll look at this one as well. This is the breadth on the S&P 500 by cap tiers. So it's the S&P on a closing basis on the top, and then we have 4 series here. This is the AD line, the cumulative advanced decline line for the New York Stock Exchange, for the large cap index, the mid cap index, and the small cap index, sort of in order. I have very subjectively color coded these: green for bullish, amber for neutral, and red if it was negative. And maybe a couple weeks ago, I changed a couple of these from green bullish, where they all were here in November. Most of them were, as we were threatening to make new all-time highs across the board, but all of a sudden they've pulled back from there. And what you're seeing now is a lower high from all four of these. You're seeing, let's say, 3 of the 4 below their 50-day moving average. Seeing a couple of these get very, very close to the swing lows from September. So to be clear, that was when the S&P was pushing down and getting around 4,350 down to 4,300. The advanced decline line on the New York Stock Exchange is right about on that same level about a week ago, right? Early December, as we bounced off of the 50-day moving average. We're once again sort of approaching those levels again. This isn't updated for today's close, by the way. These lines will most likely come down. I would say probably all 4 of them, given the action in the market today. So are these climactically negative? Absolutely not. Would I describe any of these as bearish? I don't think so. Would I describe some of them as non-confirmation? Yes. And this is the problem, right? When you have the S&P making a new closing high in early December, but all 4 of these are actually making clearly lower highs. So you're getting breadth deteriorate, which tells you, for every Pfizer breaking out this week, you've got a lot of stocks that are not breaking to new highs, if not breaking a little bit lower. You're seeing a little more deterioration than you might want if you're constructive on the market here. Just very quickly, wanted to highlight that financials are really the only S&P sector finishing in the positive today. Rates going up, and again, tomorrow will be very key for financials, the banks thinking about the yield curve and interest rates and Fed policy decisions. After that, you had staples and materials right around the 0 level. Everything else was down, with technology leading the way lower, the NASDAQ pushing lower as well. So certainly a rotation away from a pretty growthy area of the markets, the technology sector. We need to take a quick break. We'll be back with today's guest, Jonathan Krinsky. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we focus on the markets using the technical analysis toolkit, trying to understand market dynamics using a lot of charts. A couple of quick comments before we get to today's guest, Jonathan Krinsky. First off, we love to hear your questions. We're going to do a mailbag segment a little later in today's show, and we would love to answer your question live on the air in our next mailbag segment on Friday's show. You can email us any questions on charting, technical analysis, on stock charts. Whatever it is, we'll do our best to answer them. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to stockchartstv.com. So much great content every trading day, even some weekend days as well. Great guest appearances like Jonathan Krinsky, like Mark Chake and Tony Dwyer. Great conversations in recent weeks. Special events like The Pitch, our year-end review coming up in the next couple of weeks. Go to stockchartstv.com. You can also, on your mobile device, just search on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Jonathan Krinsky. Jonathan's a technical analyst at Baycrest Partners, based in the upper Midwest. Jonathan, good to talk to you. Good to see you.
Always good to be here, Dave.
So this market, we were talking just before the show started, this is a challenging period, right? A challenging market environment. This should be, I was told, there's the Santa Claus rally. This is the seasonally strongest part of the year, but you're getting deterioration, right? Particularly in the short term. You're starting us out looking at momentum. Tell us this chart and what it's telling you.
Yeah, so the first chart we have shows a momentum index that Morgan Stanley creates. It's basically shows stocks in the broad-based Russell 3000 that have very strong momentum over the last 1 year, and it kind of rebalances. And you can see on an absolute basis and a relative basis that peak back in January when we had a lot of the meme stocks kind of going nuts. And it's really just done nothing for the last 9 to 10 months. You can see that on an absolute basis. The issue is, aside from the fact that a lot of momentum stocks haven't done anything, is you can see that relative chart on the lower panel breaking to, essentially 2-year relative lows here. So I'm sorry, one year relative lows. So, on an absolute basis, you're not making money, but on a relative basis, you're actually losing money. And these are supposed to be the stocks that are, showing good momentum. And outside of, the FANG stocks, there really just hasn't been any good leadership, any momentum in areas of the market that were exhibiting momentum. And that's when people get frustrated because, you see a stock that's done well, pulls back, you think you're buying it for that momentum leadership, and it just isn't paying you. So that's the issue that the market's in right now.
So when we describe the market as frustrating, this is maybe a good chart to illustrate why that might be the case here, this leadership rotation that we've all been experiencing. Your second chart is looking at the SPLV, that's the S&P 500 low volatility ETF. Can you talk us through this one?
Yeah, so clearly the market's been under some distribution in some of those momentum stocks, and finally we're getting some of the leadership tech FANG stocks. Even Apple put in a couple ugly days here, but that money, I guess if there is an encouraging sign, it's that it is still rotating somewhat within sectors. So this is the low volatility ETF, SPLV. It's your consumer staples, your utilities, your REITs, those bond-like proxies, the defensive areas. And it actually just broke out in absolute terms this week. And you can see there on the bottom, the relative trend. It's clearly not in an uptrend on a relative basis. I would say it's breaking out of a base, maybe shifting more to a neutral long-term trend. So on the one hand, this is where investors are hiding for the near term. There's a little bit of perceived safety there. I think the bullish takeaway here is that you're not seeing this breakout in as the absolute chart is coming down, right? So in a true bear market, everything goes down. Even these low vol names would be selling off. They would just be selling off less than the overall market. And that's not quite what's happening now. So I think it's important to watch this, see if that relative continues to move higher. But if the absolute trend in low vol stocks continues to move higher as well, that tells you it's a little bit more rotational in nature and not totally just this pure go to cash, sell everything.
It's really interesting. And it's funny. I know when I've shared with some people charts of some of the names in real estate, some of the REITs, or Procter and Gamble, right? If you cover up the tickers, there's some decent charts out there, but probably not in some of the sectors that you'd like or that you may think. We just have a minute left or so, Jonathan. But when you're looking at this current market environment, where obviously we've pulled back from S&P 4700 a couple times, you mentioned momentum struggling, defensive sectors improving. How are you thinking about positioning between now going into the beginning of next year? Is this yet another setting up for another buy on the dips? How do you differentiate that from when things really start to get ugly and start to get defensive? How are you making sense of this right now?
Yeah, I mean, I think we all tend to get a little bit too caught up in the seasonal trade this time of year. So if we take away the seasonal trade, right, what you have is narrowing leadership. You've already talked about that. They're finally, we thought actually early last week, they kind of finally got to some of the leadership names, with the exception of like Apple, Microsoft, Google, and those are still, they still haven't really gotten to them. They're starting to get to in the last couple of days. So the issue, or not the issue, what we're looking for going into next year is, can you see rotation back into the areas that haven't performed well? And those, we're talking about small caps, biotech, the ARC type names. Those have gotten destroyed. And if you don't see those names start to act better and participate on rallies more, then I think you have some bigger issues, and you're talking about some bigger concerns for the S&P and NASDAQ. And so, the last 2 weeks of the year, again, it's hard, or it's easy to say that we're going to, see that seasonal trade. Everyone talks about the Santa rally, which technically doesn't start until the last 5 trading days of the year. So I think with Powell tomorrow, you have the setup for a bit of a washout and bounce into the end of the year, right? Mm-hmm. But that's a small picture in the big forest, which, it's going to be tricky in the next year. And again, if we don't see those beaten down areas start to act a little better, then I think they finally start hitting the generals, as they call it. And that's when the overall market has some bigger issues.
It's a great take, Jonathan. Listen, really appreciate you sharing some wisdom with us and talking through these charts. Stay safe. Have a great holiday. We'll talk to you in the new year.
You too, Dave.
It's Jonathan Krinsky. Jonathan's the technical analyst at Baycrest Partners, based in Minnesota. Did a great job. I love how I asked about sort of the overall conditions and how to think of them. If you caught it, he mentioned it's easy to get caught up into the seasonal trends. I'm paraphrasing, but something like that. But if you get away from that and just look at the evidence, here's what we're seeing. And I think there's a lot of there's a nugget of investing wisdom right there. I tend to think of seasonal trends more in terms of headwinds and tailwinds and less in terms of absolutes. I think we can get a little dangerous if we say we just need to sell in May and buy in November, and then we're pretty much good. We're going to weather things okay. I'd much rather focus on the market evidence and look at what the market's telling you. And I agree with some of the warning signs that he's picking up on, particularly the improvement in some of those low vol sectors, things like defensive sectors like consumer staples and utilities. Let's continue on with our next segment, the Final Bar Mailbag. As a reminder, we love to hear your questions. The Final Bar at StockCharts.com is our email. Let's get to question number one. David has once again used I love this question. David has once again used the picturesque phrase dead cat bounce. Longtime viewers will know that every time this phrase is used, the market immediately rallies straight back up and on to new highs. That's so awesome. And you're right. It's so funny. And I hear myself, I've told people I should have a research service when I'm tempted to use the phrase dead cat bounce. That is a sign that something's probably could be incredibly viable. And, and to be honest, I say that with, with a total humility. I mean, sometimes I will be absolutely wrong. And I got used to that a long time ago. What I will tell you though is one of my mentors, Greg Morris, who wrote a number of fantastic books on trend following, on breadth analysis, on technical analysis in general. But he talked about, all new highs are bullish except the last one. And I think buying on the dips has tended to be a very profitable strategy in 2021 over multiple cycles. It has tended to be a very successful strategy. The problem is when it's not a successful strategy, you get absolutely crushed, right? Think about if you buy in the beginning, late February 2020 before the big sell-off into the third week in March happens, right? What if you buy it the first leg down of a multiple leg downward trend? We just haven't had a lot of those in recent years, but they happen. And I've seen enough of them in my career that I'm ready for them. So a dead cat bounce is basically, we have the big move lower. If that's a big downtrend, a lot of times you'll have an initial reaction off of those lows when people are buying the dips, but then that runs out and no one's left to push it higher. I don't know if I can declare, defeat on that one just yet. This could be a bounce back to 4,700 before a big leg down. I'm not sure. That's why support and resistance levels are so important. But thank you for recognizing that, and you're welcome for throwing that phase around. If it gave us that bounce higher, you're welcome to it. Next question. I've heard several times that you like to run new swing high scans almost daily. Can you show us the scan and how to use it to identify potential breakouts? How do you configure the scan to include a momentum indicator? Really good question. So I'm going to go to scans. To get to your scans, by the way, if you go to your dashboard, click on scans, it'll take you down a little bit. These are all your saved scans that you have on here. The scanning engine is a fascinating, powerful tool that we rarely have enough time to dig into. If you click on new, you have the ability to build scans from scratch very quick, but you also have some really cool capabilities in terms of what you can do. I will show you there are a couple scans that I've actually run at times. There are two that I'll show you. Here's a new swing highs 65-day. And I'll show this on the screen. You're welcome to pause this or go back to it on YouTube or on StockCharts TV on demand and jot this down and replicate it. But what I'm basically saying is it's a common stock. It's traded on one of the major US exchanges. This is the key argument right here, line 3. Daily close is greater than yesterday's daily max, and it's a 65-day daily close. So basically today's close is higher than the highest close in the last 65 days, or about a quarter, about 3 months. And then also market cap above 10 billion. That's obviously a movable target depending on how big or small you want to be. It's a stock. I have that in there twice because I'm apparently very redundant. And then the group is not an ETF. I just want to get the ETFs out of there. You can toy around with those arguments to make the universe bigger or smaller, to focus just on ETFs. That is one cool thing. The problem with that, though, is it looks at just today's close. So if you have something that had a big run and then pulled back today, it won't come up on the screen. So I worked with Bill Shelby, who's sort of our internal scan engine expert, on a way to address that and just look for things that in the last week have done better. And we came up with this scan, which is the one that I use a couple times a week. So again, if you want to pause this and check it out, basically this argument, weekly close is greater than last week's max 13 close, which says to this week's close, this Friday, wherever we're at right now during the week, is higher than the highest close for the last 13 weeks using the Friday closing data. I've used this screen and it's great. It's a bunch of things sort of rotating higher and tends to capture things. I'll run the scan here real quick. 80 names come up on it. And again, I haven't run this today, so I can't really tell you much besides there are some things on here. I'll just bring up one of these and show you. So what happens is you get a mix of things. You get things that are in extended bullish phases. So Morningstar, making a new closing high this week relative to the last 3 months. So it's sort of in an extended move. You will also get things that have been beaten down and are just starting to rotate higher. Both of those would be picked up by that screen. Could you incorporate a momentum indicator? Absolutely. And if you look at the scan engine at the bottom, you can use these drop downs. I would focus on technical indicators. I would look at something like a MACD buy signal, and maybe one of the better things, predefined scans might be a really good thing to do. Bullish MACD crossover, oversold with improving RSI. Some of those CCI buy signal, those would be things that are capturing a rotation higher. So I'd maybe experiment with those. That would be a momentum factor, but anything that comes up on the screen is distributing or is demonstrating positive momentum, at least in the short term, or it wouldn't come up on the screen at all. Great question, by the way. Next question, on your market trend model chart, SPY weekly, that's this one, you use a 5, 21, and 34 exponential moving average. What is the reasoning for using those 3 specific moving averages? Really good question. I actually did a whole webcast on that earlier today on the market trend model and how I designed this and what I did to create this, why I went about it. So it's fresh in my mind. And basically, I was looking for different time frames. I knew exponential averages would be the way to go, because if you look at simple versus exponential averages, exponential is the way to go if you want to track trends. If you want to look at things that a lot of other people are looking at, I would do simple moving averages, and that's why I have them on a lot of my charts. But if I really want to create a model that better tracks trends, exponential moving averages are by far going to be superior to that because they react much more quickly to the current market movements. That's why they're so beneficial. 5, 13, 21, and 34, which are the settings that I use, are all Fibonacci numbers, if you know the Fibonacci sequence. And so I started with some different combinations of those Fibonacci numbers, tried a series of them. I settled in on weekly data and only updating it on Friday's close. And I settled with those combinations because they tracked the 3 timeframes I was looking for. Short term for me is a couple days to a couple weeks. Medium term is a couple months to a couple years. Long term is a couple years and beyond. And that combination of weekly moving averages, exponential averages, fit those timeframes pretty well for me. That's why I have those 3 settings for the moving averages. We need to wrap the show. Boy, the mailbag goes by so quickly. We really appreciate them. Keep the questions coming, and we'll get to more of them at the end of this week. We need to wrap the show, though. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the S&P 500 breadth by cap tiers. We spent a little time earlier in the show in our market recap talking about this environment. I think my conversation with Jonathan Krinsky was really illustrated the challenges of this market. Momentum, things that traditionally have been doing well, are struggling, particularly the growthy stuff that has done so well. The FANG stocks all down today, for example. In recent days, it's been maybe 1 or 2 of them that have been positive, but on average, they've been lower. And you're seeing that play out in breadth readings as well. The breadth right now is a lot lower than it was the last time we approached 4,700 and rotating even lower. These are going to downtick a little bit once we process the closing data for today. Second chart is one of the charts that I use to look at a overall risk on versus risk off. It's 5 different indicators. Starts with the S&P closing basis on the top. Are we making higher highs and higher lows? So far, I would argue we have, as long as we remain above this level 4,500 on a closing basis, that would keep us above and continue that pattern. We failed to make new closing highs, really. The common stock advanced decline line rotating lower. The consumer discretionary versus consumer staples is rotating lower, favoring staples over discretionary. The relative performance of U.S. stocks, the S&P versus utilities, is rotating lower, recognizing that utilities are outperforming. We're starting to see a declining number of new highs over the last 6 weeks. So while this is still early days, this is not what a raging bear market looks like, but it's certainly what a bull market in stall mode sort of looks like. And that's the concern I have right now. It's not that stocks broadly are going down. It's just that they're not going higher. And you're seeing some signs of concern, signs of rotation from risk on to risk off. This is a really important chart I'll continue to follow going forward. Finally, the dreaded Hindenburg Omen. We don't have enough time to get into it, but maybe tomorrow on the show we will. We've now had 2 Hindenburg Omen sell signals, I believe, in the last 30 trading days. That is not a good sign for stocks overall. It tells you the breadth conditions and momentum conditions are similar to previous market tops. Maybe we'll look at that in a little more detail later in the week. Thanks so much for watching The Final Bar. Special thank you to Jonathan Krinsky from Baycrest Partners joining us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe Have a good night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.